Welcome back. In today's video, we're going to be talking about leaving nothing on the table as we are now in the second half of 2025. We are well past the 12-month time frame after the Bitcoin halving in 2024. And as you guys know, the Bitcoin halving from the day of the Bitcoin halving to 12 to 18 months after the Bitcoin halving is the most volatile of the bull market and also an indicator of the top, at least based on historical data that we've covered on this channel extensively. But in today's video, we're going to be exploring, now that we are at the end stages of the bull market, at least that's what we believe and predict on this channel. What do we do from here? And how do we leave nothing on the table if we do enter a bear market? This is the Cryptoviser podcast. We're going to be talking about this and more. So make sure you guys are subscribed to the channel. We upload every single day. Sometimes we talk about individual cryptos and deep dives like today. Sometimes we talk about the macro and really what's going on all around the financial markets. So we upload every day. And if you want to stay on top of it and know when the signals are hitting in the market so that you can make good investment choices in your portfolio, make sure you hit the subscribe button, give the video a free thumbs up, and if you want to become a channel member, click the join button or subscribe plus button down below here on YouTube to learn more about becoming a channel member for as little as $1.99 a month. Now, this user on X who has about 60,000 followers and gives market commentary said, "Euphoria is the end. It's over. It's about to happen, and I'm telling you, it's about to be over. It's not an exciting time. It's a time to have discipline. The easy part is over." And effectively, what he's talking about is the market psychology index, or how psychology affects the market. And we've covered this previously on the video, but he believes that we are at the euphoria stage. Now, as I've covered on previous videos, I personally agree that we are either in euphoria stage or in the complacency phase of the bull cycle. This is typically, you can tell when this is occurring. You're getting phone calls and text messages from people you've never talked to in the last couple of years saying, "Oh, what should I buy? Should I buy Shiba Inu or Haktua coin? Which coin should I buy?" Right? That is an indicator, but there's also a lot of other indicators in the market, right? We can look at charting. We can look at days since the halving, like I just said. We can look at the fear and greed index. But the bottom line is, it doesn't matter where we are in the cycle. We know a bear market is going to occur at some point. And so we need to understand what to do, how to prepare for it, and how to maximize this bull market, however long there is left in the bull market, but also protect ourselves for the bear market. I think in the previous cycle, we did a really good job of this. If you guys have been on my channel, you guys can go comment down below that and confirm what I'm telling you. But back in 2022, when FTX collapsed and it marked the bottom of the market at 15,500, number one, 2 weeks before that occurred, I told my viewers on this channel, consider reallocating your portfolio and getting cash on the sidelines. That way, if there is a dip in the market, because we are approaching the 1 year after the Bitcoin top in 2021, and you may want to have some cash on the sidelines. People were writing on my most downvoted video, by the way. People were commenting, "Cryptoviser, you're an idiot. Why would I put cash? The market is still going on." We keep hearing, boom, FTX collapses. Bitcoin, $15,500. And everybody in the market was freaking out, except for us on this channel. What were we doing? We were buying. We were buying that bottom of the market, that 15,500, while everybody else was freaking out, right? And so, by the way, we also called the top of the market as well, and the lead up to the downtrend in the market. In the beginning of 2022, I told my viewers that I was selling most of my altcoins. Cryptoviser, you're an idiot. We have an extended cycle. June of 2022 is going to be the top of the market. Who was right then? I was. June was the bottom of the market in 2022 after the peak here. You can see that right very clearly here on this chart. And so while I'm not trying to brag, right, I am trying to just give context that we have had very, very, very accurate calls in the market. And the point is, whether we're at euphoria or not, it's good to at least have a plan so that when we are at the top, you're protecting the downside risk. And so this same user on X posted this saying the bull market is not over, but we are in the last 3 to 6 month window. I expect the rationality, complete euphoria, outrageous announcements, or other even developments. All of this will stir so much excitement and joy in the minds of every market participant. Good. And why is he saying good? Because that's going to be the time he's going to sell. That's going to be the time we're going to sell in the chaos of the euphoria of the top of the market. And by the way, there's a lot of signals that we are already in the euphoria, right? And in a rotation out of Bitcoin. We're not going to get into all that on this channel because it doesn't matter whether you believe we're at the top when you're watching this video or when I created this video. This is an evergreen video, right? What I'm telling you is going to work in this cycle, the next cycle, the cycle after that, and it will work in stocks, in other assets as well. So I want you guys to less focus on where we are currently in the cycle versus where you think we are. There, at some point, there's going to be the top of the market, whether we passed it or not, whether it's in the future or not, how long in the future, we don't know, but we will be there at some point. And having the plan is critical. And that brings us to his article on leaving nothing on the table. And so let's get into it. He said, you're going to take money off the table and never re-enter it. MTT with blinds rising, a push-fold strategy, and the Nash equilibrium. That's what we're going to be talking about. And so he says this is called late cycle market strategy, the poker analogy explained and validated. So a recent tweet by this person draws an analogy between the late stage market cycles and the end game of a poker tournament. The message is, as the market cycle reaches the peak or the top, one should protect capital by reducing their overall exposure while dialing up risk on the remaining positions. In poker terms, as blinds rise late in the tournament, the optimal play shifts to a push and fold strategy based on the Nash equilibrium. Either go all in or fold, rather than taking incremental risks. The tweet also says that this is how you play the top, how you walk away winning, implying that in a frothy late cycle market, a strategy of capital preservation plus selective aggressive bets yields the best outcomes. And I would agree, guys, this is what we talk about on this channel. Looking at the market and forget about where we are, just saying, is this trade over? Because it's like a roller coaster, right? You go up, you go down, you go up, you go down. But there's going to be better plays in the future than there are today. And the plays today are better than they were last week or last month or last year. But we have to rotate with those plays. If we're just saying, no, I'm just holding Bitcoin and that's it. It's like, okay, but you're going to miss all the Bitcoin stocks that you could be making money on, the Bitcoin mining stocks that you can be making money on, the Ethereum treasury companies you could be making money on, right? There's other areas that you could be making money, but nope, I'm a Bitcoin maximalist. I'm not going to do any of that. I'm just going to hold my Bitcoin and that's it. It's like, okay, that's your strategy. That's fine. Nobody's there, but that's not what we do, right? We are trying to maximize as much as we can in these market moves. And that's what he's talking about here. So what he's saying is, as we are getting into late stage, right, whether we're at euphoria or in the thrill stage, like the further we go, the closer we are, right? And so the further we go, the closer we are, we need to protect the capital. Otherwise, what happens is, similar to what happened with FTX, they just keep over trading. As the market declines, they double down because they think, oh, no, this is just a dip. But it's not just a dip, it's the dip, right? And the dip's not over. And so we go down a little bit, they double down, we may go up, which gives them more confidence that they're corrected. This is just a dip. But then we keep dipping and they keep doubling down and then we dip again. They keep putting more in, thinking, no, it's not over, it's not over, it's not over, it's not over. And no matter how much info, how much data you provide. I mean, I show you guys videos on this channel with data of where we are in the cycle, that we're already in euphoria or even in the complacency stage. And people say, no, Cryptoviser, you are so stupid. We are in the optimism phase. And it's like, okay, maybe we are. But if you are thinking that way, it shows that you don't even have a plan for an exit. And not only for an exit, but for an exit that you're going to secure. Not an exit you're going to go re-gamble. Because that's what happens. People win in the casino and they keep gambling. And before you know it, they're back to zero and they're taking out more money. Same thing happens in these markets. Continuing on, in simpler terms, this strategy recommends cashing out a significant portion of your investment near a cycle's peak and only risking a small selective portion in high risk, high reward bets rather than remaining fully invested. So this is an example, right? If you believe that we are towards the top of the market, you take profits out of coins that have already performed, whether they've done 50% increase or 500% increase. You just sell all of them. And then you look for high conviction trades. For instance, an Ethereum treasury company, right? You sell your Bitcoin or your MicroStrategy, and then you immediately buy into the Ethereum strategy companies, right? A few weeks or a few months ago when they first started announcing them. You would have already been 10x higher. But let's say you took out $10,000. Like, let's say that was your entire portfolio in crypto, and let's say you took out $10,000, and you only put in 1,000. Put in 1,000, you took out 10,000, you made 9,000 in profit. A lot of people, they're going to take that 10,000 and then just reinvest it in Ethereum. But what if the Ethereum thing doesn't work, or this altcoin doesn't work out? Now you just lost everything. You not only took a gain, but you lost the gain and everything. What you can do is, if you take out 10,000 and you only put 1,000 in, you secure 5,000, right? 50%, or whatever the portion is for your strategy, right? You have to come up with these numbers on your own. But let's say 50%, right? So you take 5,000, now you're 4,000 in profit, secured, guaranteed, and you have your original investment. And the next 5,000, you're going to put in these high conviction plays. Whether it's an altcoin, whether it's a meme coin, whether it's a stock that you think is, was in a bear market and now is starting to see the rotation into bull stage. These are high conviction plays, but it's not risking anything. Like, if you lost that $5,000, well, you're still up 4,000 from the other 5,000 that you put aside, right? And that's what they're talking about here, reducing the risk. So here they talk about late-stage investing principles. At the tail end of bull markets or economic expansion, market risk is an asymmetrically high. Potential upside is limited while the downside risk grows. Sound financial principles argue for capital preservation in this environment. This often means reducing exposure to risky assets, taking some money off the table, and raising cash or safe assets even if it sacrifices some final stage gains. Perfect example, right? A few months ago, I called the top of the market for Bitcoin. And I said in the video, like, this is the general top. There's a very high likelihood Bitcoin's going to go higher. But this final stage of going higher is the euphoria. And there's going to be a lot of profit taking. And there is. Like, people think that, oh, nobody's selling their Bitcoin. It's like, no, they clearly are selling their Bitcoin. That's why the price is not going up that much. But I called the top at about $112,000, and now we're at $120,000. And people are like, Cryptoviser, you're an idiot. You see, you missed it. We weren't at the top. You could have, we're at $120,000. It's like, yeah, but that's only a $10,000 difference, right? It's less than 10% increase from where I called the top. If you have that mentality like, oh, I missed it, that's where you FOMO in. People are saying, Cryptoviser, that's fine. Whoever's going to sell now, we're going to buy it, and then you'll be buying back at $250,000. Like, maybe, but if you are so bullish on Bitcoin regardless, and it's going to go up regardless, if I rebuy in at 250,000, it's still going higher, so I still win. It's not like I'm losing. But if you don't take profits out, and then the market does fall, you lose, right? The strategy that we're talking about, this is a no-lose strategy because you're already in the green. You're securing at least your initial investment, if not more, on the side. And then you're just taking a small portion of your winnings and reinvesting it in these high conviction plays. So if you lose those, it doesn't matter. You still win. You're not going to win every trade. Anyway, continuing on, Warren Buffett's famous advice encapsulates this. Be fearful when others are greedy, and greedy when others are fearful. I completely agree. When investors have bid prices to euphoric highs, which is greed, Buffett becomes fearful, anticipating a plunge and pullbacks. In practice, that translates to a scaling down of positions as market reaches speculative excess. Professional investors who also advocate for late cycle defensiveness, for example, Wellington Management's Capital cycles approach explicitly favors capital preservation at cycle extremes. Near peaks, they seek short exposure to late cycle areas where capital is abundant and maintain an active allocation to cash, while only pursuing long positions in certain early cycle or undervalued areas. In mid 2017, a time of widespread bullishness, Wellington's team noted consensus is too optimistic and adopted a comparatively conservative risk posture, holding extra cash as dry powder for future opportunities. This is a textbook late cycle playbook. Raise cash, trim exposure to overheated assets, and only take focused bets when you see exceptional value or hedging opportunities. I completely agree, guys. We have Raoul Powell saying we have an extended cycle into 2026. What? This is the same thing as last cycle in 2021 when people were talking about the stock to flow model, which was a complete and utter bullshit failure, right? Because they're like the billionaires need you to enter or Wall Street to enter so that they can exit. If there's no money coming in, there's no money going out. And so you need to capture that money while it's still there. And there are people clearly doing that. That's why Bitcoin is not at $250,000 when MicroStrategy has been buying billions and billions and billions of dollars every single month. And all these other companies are now getting in the game. But they're getting in the game at the end of the cycle. They're giving you the money and they're telling you, we are going to put this money into the Bitcoin market. They are telling you, we are giving you exit liquidity. Take it or don't take it. But if you don't take it, you may not be able to get that liquidity back for years till the next cycle potentially. Anyway, moving on. Similarly, PIMCO's asset allocation in late stage cycles involves lowering overall risk, which is beta, and favoring liquidity. Bingo. Wow. Almost like I wrote this article. Anyway, PIMCO strategists wrote that they reduced overall beta exposure to reflect lower returns and higher volatility expected late in the cycle. They emphasize holding assets like cash as dry powder to deploy after dislocations. In essence, as the market hits a top, prudent investors pivot from offense to defense, prioritizing not losing money over squeezing out every last bit of upside. Because when you're squeezing, you're greedy. And when you're greedy, you lose. So then dialing up risk selectively on the remaining capital might seem counterintuitive at first. Why increase risk on any portion if the environment is risky? This relates to positioning the residual exposure in such a way that it can still generate outsized returns without jeopardizing the bulk of your wealth. It's akin to Nassim Taleb calls of the barbell strategy, where one portion of the portfolio is extremely safe and the other is very risky, with a little in between. He prospered during the 2007-2008 crisis using this approach, saying if you know you are vulnerable to prediction errors, then your strategy is to be hyper-conservative and hyper-aggressive as you can be, instead of being mildly aggressive or conservative. In practice, that means placing the priority of capital in safe assets while allocating a small slice to high upside, high risk bets. This way, you greatly reduce the chance of ruin while still maintaining some exposure to further gains or optimistic trades. The barbell theoretic backbone for the tweet's idea of lowering capital and dialing up risk. It's a strategy explicitly designed to avoid going broke in an unpredictable environments by lowering exposure, even if it means foregoing some average returns. The payoff is that you survive market crashes intact and have cash to buy assets cheaply afterwards. Because guys, we are going to hit a bear market at some point. I don't know how low the bear market's going to be, but we will. And the people who believe that we're not going to hit a bear market, they are going to have $0 to buy that bear market. Zero. They're going to be stuck in all their positions. They're going to be in the red in all their positions. Right? There's people who say, with Cryptoviser, we haven't even increased it. Like this, we haven't even entered the bull market yet. It's like, what? Bitcoin was 15,500 at the bottom. Almost 10x. It's actually about 8x. And if you look at the Bitcoin halving tracker, that's kind of in line with what the Bitcoin halving tracker's diminishing returns over the previous cycles looks like. So if you're anticipating $400,000 or $500,000 Bitcoin, guys, we can't even get above $120,000 there without massive quantity of selling. And by the way, the treasury companies, like, they're not all buying regularly, and the debt is going to drop. I mean, eventually people are going to stop buying this debt that they're selling. But the bulls are going to say, no, Cryptoviser, we're going to go up forever. And it's like, okay, you do you. You do you. In a bear market, let me know how it's going, right? Because again, in the last cycle, I called the top of the market to the month. And then in the altcoins, I called the drawdown. I said, guys, get out of these alts. And Cryptoviser, no way. We're in an extended cycle. The same bullshit that we're hearing this cycle about extended cycle. These people are going to leave everything on the table. They're going to go from multimillionaires on paper to nothing in a year. And it's sad because they're not looking at these videos and saying, like, thinking about it strategically and also, like, logically. So in summary, established market wisdom supports lightening up a broad exposure as the cycle peaks. Not at the peak, because you don't know it is the peak until after the peak. So whether you get in before the peak, after the peak, or during the peak, you're still much higher than everybody down here. And so personally, if everybody thinks we're approaching euphoria, we've already passed it. If everybody thinks we're in complacency, we already passed it. If everybody thinks we're in optimism, we definitely passed it. Something to keep in mind, right? Protecting the bulk of one's capital is rational when valuations are stretched and downside risks outweigh further upside. Any continued participation in the late stage market should be limited to select high conviction plays, effectively shooting for the double or nothing with a small stake rather than risking the whole pot. This approach is grounded in fundamental goal of avoiding large losses. One person emphasizes, if you avoid the losers in bad times, the winners will take care of themselves. Avoiding a massive drawdown at a market top is crucial because a loss of 50% requires a subsequent 100% gain to even break even. A lot of people miss that point. They're like, oh, we've only gone down 50%. Yeah, but now you have to do a 100% increase just to get back there. It's twice as hard, especially when you're in a downtrending market. So it's far better to miss a bit of late upside than to be fully exposed to a collapse, a point we see reinforced in studies showing that missing the worst market days greatly improves long-term returns. In essence, the prescribed strategy mirrors the age-old investing tenet. Capitalize on strong markets, but don't be left without a chair when the music stops. Or as Buffett put it, only when the tide goes out do you discover who's been swimming naked, a warning to always keep your risk in check so you can survive the downturn. I mean, we're hearing from the MicroStrategy bulls that there's no possible way that we're going to drop. There's no possible way we're going into a bear market, but we are going to be there. And we're getting closer and closer to that point. Because the further we go, the closer we are. Whether it's in 1 year, 1 month, or 10 years, it doesn't matter. The further we go, the closer we are. And so do you want to exit this bull? Guys, I've been following crypto on this channel since 2018. I'm telling you, if you have not taken profits this year yet, you are missing the point of this market. And I'm telling you, by next year at this time, there's going to be people who are millionaires today who have nothing. And again, it doesn't matter whether we're in the 2025 cycle, the 2028 cycle, the 2032 cycle. It doesn't matter. Bitcoin is going to be following this 4-year cycle. And it's going to have very similar kind of moves depending, because as time goes on, there's going to be more buyers of Bitcoin, more integration in TradFi. And we're going to see the transition away from traditional finance and the banks and the traditional stock market. And everything's going to be tokenized on chain. And so over the course of time, yes, all these assets are going much, much higher. But it's going to take a lot of time, decades, to get to these multi-million dollar valuations. But in between there, we're going to have a lot of volatility. And the volatility to the upside is what you want to capitalize on. And the volatility to the downside, you also want to capitalize on. Buying in the upside, selling in the upside, buying in the downside. A lot of people are going to miss it, guys. We are in late stage cycle. Whether we're in thrill, euphoria, or complacency, we are very close to the top. And if you're thinking, whenever you're watching this in the cycle, that we're not here, look at the signals. How much excitement, literally, if you watch Bloomberg, CNBC, or Fox Business in the middle of 2025, everybody's talking about Bitcoin, everybody's talking about Ethereum. They weren't doing that last year. And so are we at the top already? That's a question you have to look at in your own portfolio and make a decision. But the point is, the euphoria is going to occur very rapidly. You see, the euphoria stage is quick. And so if you don't capitalize on that, you miss it, and potentially buy at the top, because a lot of people are going to get caught up in that euphoria as well. They're going to have to wait years, potentially never, to recoup their losses, because we've seen a lot of cryptos through the years not reach their all-time record highs, not reach their previous cycle highs, and they may never do it again. And so you have to be really, really careful at this point in the cycle what you're investing in, especially if you're using profits or sales from other assets to then go and buy these assets. And if you are doing that, high conviction plays, very short trades, don't marry your bags, because if you do, you're going to miss it. The top of the market, you're not going to know. I'm not going to know until afterwards. And I don't care if the top of the market is $50,000 higher than when I sell, or $100,000 or $500,000 higher than I sell. If I'm making a profit, it's never a bad trade. And you have to think about that as you're kind of in these markets here. It's never a bad trade if you're in profit. Hopefully you guys enjoyed today's video. Consider becoming a channel member for as little as $1.99 a month. We upload every single day completely for free. All I ask is that you give the video a free thumbs up. But if you want to help support the channel financially, click the join button down below to become a channel member for as little as $1.99 a month. I'll see you guys on the next video. Invest responsibly, do your own research, and remember, leave nothing on the table. Crypto on.